Hey YouTube, this is Zach with Achilles Financial, and today on CNBC's Closing Bell, we got to hear from Cathie Woods, who is the genius behind ARK Invest. And when asked what was the number one stock that was undervalued in her portfolio that people should know about, it was Invitae or Invitae, depending on your pronunciation. I believe it's Invitae. But again, this trades under the ticker symbol NVTA. And there is a lot to like about this company. I personally am not an investor. I don't have a lot of exposure to biotech in particular, or just the genomics world or the health world in general. But this is a company that does a lot of genetic testing. What we're going to be looking at today is not only their website, where again you're looking at different genetic potential diseases that you may have or your family may have, but rather we're going to be looking at their financial statements, their growth over the past 12 months, as well as what this may be for the future. So first and foremost, let's head over to the TD Ameritrade, and I'm going to showcase some of their long-term financial information, and then we'll dive into their investor presentation from this past quarter, where they announced results on February 17th. So as you can see, here we are in NVTA. Again, they trade under the ticker symbol, or they trade on the New York Stock Exchange in the biotech subsector. So what you're seeing here on the screen is kind of just the summary level information. What I really want to highlight is they do not have a PE ratio, price to earnings ratio, because they are currently not profitable. And you can see that on the EPS side. One thing there is to note is they have less than 200 million shares, and that tends to be good because, again, that means that the stock can move a little bit easier. This is a $7 billion company by market cap, although I want to highlight that as we look at the charts, they are they are experiencing some of that sell-off that we've been seeing this calendar year. Again, they were north of $55 a share. Let me show you the 1 year timeline on this, because again, they really started picking up this past summer along with the broader COVID spectrum. Again, you can see they've had some pretty strong earnings, but again, they've been kind of drugged down with the broader tech and biotech sell-off. So again, a lot going on with the company. From a valuation perspective, they have a negative price to earnings rate, or they don't have a price to earnings ratio, but that's pretty typical for this world. You can see kind of the industry average right there, because biotech has a lot of companies in there that are not making any money. From a price to sales ratio, you can see that very similar in the biotech world. But 24, I would say, is not terrible for a company that showcases a lot of potential growth. So they actually look like they're a discount from a price and price to book perspective. You can see some of the growth rates, which is what I want to focus on, is that they are heavily reinvesting in themselves. And you can see that on the EPS, where we're not seeing any growth there, but we do have revenue growth quarter over quarter of 56 or 46%, and revenue growth year over year of nearly 30%. And that is very, very good. However, we're looking at it from the industry perspective right here, still relatively lower, but a lot of future potential. Again, I'm not going to complain, because this company is significantly larger than they were even a few years ago, or even last year. And then lastly, I want to talk about some of the financial strength. Again, from an overall debt perspective, I'm very happy that a biotech company doesn't have nearly as much debt as you would expect, and they seem able to cover that debt using the quick ratio, which again is just kind of quick assets. You can see here current assets over current liabilities. So let's talk about some of the fundamentals and why this company has caught Cathie Wood's eyes, and why this may be beneficial for them going forward, despite the fact they're off their all-time high of $61.59. So basically a 50% discount, and I wouldn't be surprised if we saw this run tomorrow. They have a very strong cash position for a company of their size. I'm going to do this on the quarter-by-quarter basis, where they've got right at 48 million sitting in they've got right at 354 million sitting in their cash reserves, which again is a very strong cash position and could be used to finance further acquisitions from a strategic perspective. This is a company that did acquire Archer RDX, or Archer, last year, and they were able to leverage that to help grow their overall revenue. I can showcase that here in the income statement, where again you can see the revenue is going up. Unfortunately, we are seeing pretty heavy hits on the net income as well. And you can see that largely because they are heavily focusing on the overall growth side of the house. So yes, the revenue is growing exponentially. I mean, these are quarter over quarter numbers. If we show this on an annual basis, you can see these are some huge growth numbers, but at the same time, it's not super beneficial when your expenses are growing significantly more rapid. So that's something that I want to watch going forward, is how you can avoid quarters like this where again you're losing $300 million. But again, this is what they're highlighting. So let's go look at their investor presentation and see why they believe that this is okay. So here is the Invitae presentation that they used on February 17th, talking about last year's financial results. Again, as always, I'm just some guy on YouTube, so make your own investing decisions off your own due diligence. I do want to talk about that they are growing significantly faster than they were in 2019 as well as 2020, both in terms of revenue as well as the volume of the tests that they are doing. What I am going to be looking at is how they can continue this type of growth. 250,000, which is what they're nearing, is not a lot of people in the grand scheme of things. So if they can, and by the grand scheme, I mean like the entire United States. So I'd love to see how easy is this to double, triple, or quadruple. And that kind of lines up with how can we expect this to grow. So Q4 was the first time they had ever had more than 100 million in gross revenue. And that is a 29% increase year over year. These are huge numbers for a company this size. And this is one of the reasons why that ARK is so heavily invested in this company and has so much belief in it, is because you can even see here on the screen that they are actively taking these strategic acquisitions and adding them directly to the bottom line. The question is, how can they do that over time? One thing that I really want to highlight that is good is that they are actively recognizing revenue at the point in time of delivery, where a lot of companies that we look at on this channel are showing bookings where they actually haven't delivered on the service, and so they're not counting that as revenue. Granted, this company is now publicly traded. The billable volume continues to go up, a 41% increase year over year. That's what we're going to be watching for. And the next report is, are they able to destroy Q1 tests from last year, where again they had that kind of first big spike that you can see right here before that subsequent decrease. That's what I want to see. Are they able to have a full consistent year where they're not bleeding cash but rather growing at that same rate? So you can see again some of the breakdown of where that interest is coming from. I'd like to see this continue. As we go through this, you can see that the cost of the goods sold continue to go down. I want to see the administrative cost. So those fixed costs, because at the rate those are going up, this is very, very painful. Although this is the variable cost. If that can drop, then I imagine the fixed costs can either stay stagnant as revenue grows or hopefully grow at a slower pace. Because again, they're saying gross profit here of 32.2 million. And I am happy about this because from a overall gross margin perspective, 30% is pretty great. Non-GAAP, I'm not as interested in. I want to look at the GAAP gross margin, 32% that you see right here. But then where is all this money going? And that is where you see right here of essentially how are we losing so much money when you go from 134 per share in Q4 to 452. So that is a lot of money, and it says that they're reducing the spend for the base business and they're excluding acquisitions. However, that is a key piece of how you look to grow going forward, and you can't really continue to fund future acquisitions without paying off some of your current debt going into next steps. So I'd like to see some of that kind of move away because, again, a lot of this can be somewhat painful as you go through this process. But again, this is a healthy growth for the company and one that I continue to believe in going forward, despite the fact that it was painful. And you can see again, cash burn of nearly 75 million. So some of the companies that they are partnering with, again, you see Archer right there, who they just purchased. The thing I want to highlight is PacBio. This is a stock that has skyrocketed and one that I want to see continue to perform very, very well. And it's interesting that they're partnering with Invitae to be able to do that. For that reason, I think that both PacBio as well as Invitae are good long-term investment. You have to remember, if you thought it was good at $50 a share, you thought it was good at $40 a share, I anticipate that this is going to continue to be a very strong market. And you can see right here, the term that's not included here is total addressable market. If you sum up all these numbers, we're still looking at right at $180 billion. And for that reason, I think that there is a lot of potential, maybe not 180 billion, 160 billion. But again, there is a lot of potential here for both as the United States continues to age, you have a lot of potential testing on the older piece of the population. But again, even on addition or new births, there's still a lot of potential here, even from a familial perspective. So how can they get bigger? Again, I highlighted that they only have 250,000 customers. That's a lot less than even someone like a 23andMe has here in the United States. And we've talked about 23andMe going public through VJack with Virgin Galactic's Richard Branson before. I like this business model a lot more because they actively are showcasing potential profitability going forward. So if they can continue to grow and not go through another acquisition that bleeds cash right from the get-go, then I think there's a lot of potential here. So once they, again, continue to scale, there is a lot of potential. Remember, 250,000 tests last year. How does that 250,000 go to 250 million? Again, I have no belief that they're going to hit that number, but 2.5 million would be 5x from where they are today. So they're doing a lot of that groundwork today to be able to build that up. And again, the more that they build up that database, the more residual value the company has. So those are some of the key things that I want to talk about today. Again, they've got their model on how they're going to be able to do that. But I just want to leave with the cost of revenue piece that you see here, because non-inclusive of the very expensive acquisition that they did, you can see that the cost of revenue in 2020 right here was $198 million. And that was very, very expensive on this particular approach. But you can see that if we can kind of get out of this 200 million to bring in 38 million, then we'll be in a really good spot going forward, especially if this cost continues to drop. You can see 284 and then fiscal year 299. So as that continues to drop, hopefully these numbers continue to drop as well. From a profit perspective, you can see here that again, as you start to see some of this movement, if we can bring down the overall cost of revenue from that 198, if this number stays stagnant or lowers at all and that revenue continues to climb, or at least climb proportionally, I think we'll be in a very good spot. So overall, I like the company. Again, when the bulk of your pain points is R&D as well as purchasing another company, I think you're in a really good spot. Again, 125 million right here is where a lot of that pain came from. So if you can get rid of that, then these numbers look very, very good. But overall, there's a lot going into this company, and I think that there's a lot of potential going forward. And for that reason, I really like them, and I have liked them prior to Cathie Woods announcing them, but I want to make sure that everyone on my channel had the capability to check them out. So if you want to talk about this, if you want to talk about biotech, feel free to join the Discord in the description below, or leave a comment and like below. As always, I appreciate all of you, and if you find this content helpful, please leave a like and subscribe.